Joining me live now is Evan Lucas. He's the Chief Market Strategist at InvestSMART. Evan, good to see you. Thanks for your time. So there had been some resistance to inflation happening here in recent months because of what's going on in the US and other countries as well. But it seems as though it's now becoming a pretty strong reality, and it may well force the RBA to change its position.
Possibly, and that's the debate that happened yesterday. So I'll get to that part of your question in a minute. You're right to see inflation. And when we talk about inflation, there are several ways of looking at it. So when you see the headline figure, it came in year on year at 3.1. That's actually slightly less than the previous quarter, which was 3.4. But that includes things like food and fuel. The one that the RBA looks is where they strip that out. We call it core inflation, or what they refer to as trim mean inflation. And that, for the first time since the third quarter of 2015, actually breached its mandated range, which is 2 to 3%, at 2.1% year on year. So that is where that movement up has finally happened. It's because things like housing is certainly driving that forward. Construction was a major part of it as well. And consumption is also helping that inflation movement up. You're right. The question now is this going to be a sustained movement into that band? Does it mean that we get to a scenario where we can pull the trigger on seeing rate rises? The market is certainly pushing that way, and it's actually getting quite argy-bargy. There's almost like a sort of a fight going on inside that. Market participants and economists are now forecasting that rate rises in Australia could happen 3 times next year, not 2024, next year. So the expectation is that by December next year, we could actually have the cash rate, to these people anyway, at 0.75 of 1%. That would be very aggressive. I think that needs to be pointed out there very clearly. And it would certainly go against what the RBA is saying publicly and also privately around what they want to do. They want an overrun, but at the same time, if you have inflation in this level, it needs to happen. I will point out very clearly, they are saying that realistically inflation needs to be about 2.5% and holding there for at least a minimum of 2 quarters. They're probably actually more saying 3 to 4 quarters. So that is where the caveat comes with that debate.
So 2 questions here. So if it goes to 0.75, what's that going to mean on average with bank home loans? Where would that be?
So rule of thumb with bank home loans, which is a great question, is that you add 2% to it. And the reason for that, so banks are making, when they report, they call you what their net interest margin, it's about 2% across them. So if you look at 0.75 of 1% in terms of where the cash rate sits, it's not perfectly done like this because there's actually other parts to that mechanism, but you would be suggesting that home loans would be averaging at about 2.7%, which means more likely that the standard variable rate will be in the 3s and well and truly into the 3 handle.
I tell you what, Now that's interesting. A few people in the know have suggested something similar, perhaps even worse than that to me in recent weeks. But what's that going to mean for people who have overindulged when it comes to home loans? That's going to be a huge problem for them.
Yeah, and so the second part of that question as well that I think is fascinating is that right now, what is going on in the housing market is amazing because we know that macroprudential rules are coming in. Those are the rules that are going to change the regulation requirements that investors and first homeowners, owner-occupiers have to reach. So that's that 6 times their debt to income ratio is what's going to come in December. Right now, you're seeing this absolute flurry of people trying to beat that mandate. And that gets back to your exact question, which is part of the problem, is that people are trying to, therefore, leverage up now before those changes come in. Then you couple in what we're discussing about possible rate rises next year. Now, my personal point of view is that I don't think they're going to do that. I think at best it might be 0.25 of 1% by December next year. But you are right to be forecasting this idea and having this debate is that what's happening right now, that pickup in housing, that very much that investor-led, overdriven movement into leverage with home loans is going to come back sooner or later. And the question now is it sooner, now that we're discussing that inflation could be getting well ahead of itself?
Yep, agreed. All right, Evan, good to chat as always.